This computer. Okay, the recording has started. Today, how to consistently book profits in multiple market sectors. So today we're going to be looking at numbers so you understand profits and losses and how the numbers add up and how you really need to know those numbers to know if you expect to actually make money when it's all said and done and not just by luck. So trading should be like a business where you have an expectation of profitability, not just get lucky and be profitable or unlucky and have a loss. So at the end of the year. So if we look at it from a business point of view, how can we know that we're going to be profitable? And that takes some planning, not just pure luck. It is not luck. It's executing a plan where we have an expectation of profitability. Okay, disclaimer. This is everything I'm showing you today is how is giving you is for educational purposes only. We're not giving any specific trading advice. It's showing you how myself and Becky, who's the co-host, how we go about profiting from the markets is the way we've been doing it for quite a while. Hasn't really changed much as far as options goes. The strategies we've been trading and managing positions pretty much the same way for many, many, many years. Some of those actual strategies that we've tweaked along the way a little bit for more profitability, but actual position management, that really has not changed. How we take profits really has not changed. It's because it works for us. So we'll be taking a look at that in one particular strategy that might be coming valid really, really soon in multiple market sectors. So it's a good time to for this presentation. All right. So let's go down. Some of you have seen this list before, but these are the only sectors we trade with options. We chose this list because with this list, it gives us a lot of diversity and they have enough options, open interest to allow us to place our trades comfortably and know we can get in and out of positions. There are other ETFs representing sectors, but some of them don't have enough option volume, open interest to make trading options on them realistic. The open interest might be like 10 contracts as opposed to several hundred contracts or several thousand contracts. So getting in is easy, getting out, you're going to be screwed basically it's just the bid-ask spread is huge and it's not worth, those are not worth trading. So this is our list we trade with and just this list, no others. And we've been trading the same list of ETFs for many years now. All right. So we're going to be looking at a strategy some of you have seen before. But the main thing I want people to understand are these numbers. I'm going to use an example. I have two examples in a handout. I'm going to put the link for the handout in the chat window. You'll see a link for the handouts. So that's the website they're at. You can go there and download them. Okay. So I'm going to take a look at a couple of ETFs, and we're going to take a look at expectations of profit and loss. And I want you to understand numbers and how the numbers add up. So let's start out. Everyone, if you can, pull out a calculator right now. And we're going to do some numbers. I'm going to be asking you for some feedback. You can either type it in or unmute and say something. Okay. When we're talking about options and we place a trade, because of the variations in option pricing and all the different variables that affect option pricing, even if we're doing directional trades and we say we want a 3-point target, we don't know what the option is going to be worth when it gets there because it might take a day to get there. It might take a week. It might take a month. It might take 2 months. And it might get there quickly. It might get there slowly. It might go up. It might go against you 1,000, 2,000 points first, then come back your way. So we don't know what the actual value will be. So, but based upon history and live trading, we know based upon the strategies we trade what to expect over time, percentage return wise and profitability. But let's take an example where we are risking $1,000 per trade. Okay, $1,000 per trade. So, and I'm going to type it in, $1,000 per trade in the chat window. 1,000 per trade. Okay. So $1,000 per trade is our risk, meaning we bought $1,000 worth of call options. And on average, we average a 25% return on our trades. Okay. So let's say we place 10 trades, and I want you to tell me, if we average a 25% return on a winning trade and we're at 80% wins, what is 25% of 1,000? Go ahead and type it in. If we average 25% return on at least at the first target, To get more, you just trade trail stops. Okay, $250. If on a loss we lose $1,000, how many trades do we need to have placed to be profitable? If we averaging 250 on a win, averaging, not max, not max out, just basic averaging that much, how many trades do we need to place to actually be profitable? If we're going to lose for every, let's say we place 5 trades and we're at 80% wins, that means 4 out of every 5 trades will be a win and 1 of every 5 will be a loss. If 4 out of every 5 trades is a win and 1 out of every 5 trades is a full loss, how many trades do we need to place to be net profitable? Anyone? Okay, so if we make $250 on 1 trade, how much do we make on 2 trades? Put a number in for me. Let's type it in. How much do we make on 3 trades? Type it in. How much do we make on 4 trades? And then we have a full loss. How much did we just lose? I think you meant 1,000, Olga, right? Okay. Now we have not made any money. How much? So now we need a 5th trade to make money. Another one where we make 250. Right? We had 4 if we had 4 trades where we made 250 and 1 trade where we lost 1,000, we are literally at break even. We need 1 more, which puts us over 80% wins, which is how we trade, to be profitable. On the next trade, we make 250, correct? That means after a total of 6 trades, we are plus 250. That's trading. Okay. That is realistic trading. It is not about making money on every single trade. Okay. It's not realistic to think you are going to make money on every trade. And what a lot of people don't think about is all the losses. And if you don't have control of your losses, if you don't have an expectation of profitability, you don't know whether or not you're going to actually make money or not in the long run, unless you understand the numbers related to what you're doing. It's trading. If you want to do it for consistent profitability, you really have to understand the numbers involved in what you're doing and not just guessing. It's not hoping and wishing you make money. You have to be doing something where you have a statistical expectation of profitability. If you did exactly what we just did here using our strategies, and you're getting in about 10, 15 trades a month, and the numbers are coming out like we just showed as an example, there's going to be about 83, 84% winning trades. That comes, and you're risking about 2% of the account per trade. This is how we trade. This is real numbers now. If you do this type of trading and you're getting in 10 to 15 trades a month, okay, that comes out to, and you're only risking about 2% of the account per trade, factoring all the wins and losses, that comes out to about a 20% annual return on your account. If you're risking 3% of your account per trade, that comes out to about a 30% return on your account per trade. Excuse me, on your account per year annually. If you're risking 4% of your account per trade, that comes out to about a 40-something% return on your account annually. Okay. And when you understand those numbers, you can get a realistic expectation from your trading. You're not going to double your money every year trading unless you are taking massive risk in your account and gambling and letting it ride and that type of stuff. And there are people who do that, and they'll make a whole lot of money and then they'll lose a whole lot of money. That's when they usually contact me. I've had people who have literally turned tens of thousands of dollars into over $1 million and then lost $1 million because they got lucky when the market was going up and when the market was coming down. They didn't really know what they were doing, and bearish markets show you whether or not you really know what you're doing or not. So this is how we trade. The way our numbers also works out, we end up making $2 to $3 for every $1 lost in the end. You've heard about risking 1 to make 3. Well, we look to make 3 for every 1 lost. That's our goal. Realistically, it's going to be making 2 to 3 for every 1 lost, because we're taking profit. The problem I've always had with the risk 1 to make 3, well, let's say we risk $1,000, we want to make $3,000. When the position is up, you've doubled your money, it's now up $2,000. And then it can go all the way back to 0 and a full loss because it's the wrong type of trading, especially with options. Because the longer you hold a position to try to get more out of it, the more money options don't work like that. You can maybe get away with that with shares, with futures, with Forex, do that with options. And it can time decay against you really fast. If it goes against you, it won't come back because of time. So with these options and the way we trade, we do everything by numbers and an expectation of profitability. All right. So this is something I usually go over more one-on-one with people when I'm coaching them so they understand it. But I'm not sure if I've done this. It's been a while since I've showed this type of numerical example in a meetup, but it's been a couple of years since I've done that. But you really have to understand the numbers and how they work out and the consistency. And when I say $1,000, if you're risking $1,000 a trade, then you have to risk approximately $1,000 on every trade. If you're risking $500 a trade, then you have to risk approximately $500 on every single trade. If you're risking 5,000, you have a bigger account, or 10,000 per trade, you have to risk 10,000 on every single trade and be trading a methodology that's repeatable and know what your percentage win to loss should be. If you're trading something that has 80% wins, that's great. But if you're trading something that has 60% wins, then your allocation of funds have to be allocated such that historically, you've done the math that if you have 4 losses out of every 10 trades, that's 60% wins, that you will, in fact, actually make money. Okay. It's a lot easier to do with shares or futures or Forex than options, but you have to know that if you're trading lower probabilities, that it will still work for you and you will end up being profitable in the end. Yeah, I just said a whole lot of stuff and it may not always be clear. So do we have any questions before we move on? Because I really wanted to explain this part because that's going to be kind of the foundation of being consistently profitable, is understanding whatever you're trading and how the numbers work out. Do you have any questions? Just unmute, ask it, or type it in the chat window. See. Okay. If we got no questions, I'm going to go ahead and move on to the handout. Okay, we're going to be looking at XLB. This is one of my favorite ETFs to trade because of the high win to loss percentages for one of the strategies which I've shown before. And this particular one is setting up right now, and we expect it to become valid sometime really soon. A lot of ETFs after a pullback. This is one of our first buy signals we see following a pullback. So this is a Donchian cross. And what it is this orange line here, the Donchian mean line from a Donchian indicator. This blue line is a 40-period simple moving average. And this dotted line is up a Bollinger Band, okay? What we look for is pretty straightforward. We're looking for the Donchian mean line to cross over the 40 SMA, the 40-period simple moving average. I'm going to take this to the actual chart. I'm going to switch over from the presentation to the chart and then look at that, and then we'll take a look at numbers. And I'm changing the share now. Okay. So once again, the orange line is a Donchian mean line. This is the 40-period simple moving average. The blue line and dotted line is up a Bollinger Band. I don't show the other Bollinger Band lines because we're not using them for this strategy. I don't show the other Donchian lines because we're not using them. So anything not being used, we take off the chart, or they just clutters up the chart with extra lines, and we don't need to see it. It gets in our way. All right. So this strategy is pretty straightforward. We look for the orange line to cross the blue line. Sometimes it's not totally clear what day it crossed. You take a look at a data box on this left panel here. On this day, the orange line, the mean line, and SMA, take a look at the numbers. The mean line is less than the SMA. So it did not cross bullish yet. On this day, the orange line is greater than the SMA. That's our bullish cross. Okay. That is our trade signal. And there's some other criteria with how many days this has to be below the SMA and the upper Bollinger Band, but this is our trade signal. On this, now, we measure volatility and we based our profit objectives on market volatility, not option volatility. We do not do option analysis. It is not that complicated. All analysis is done on the underlying ETF. So the volatility of the ETF on this day, we're using the ATR. And on this day, it's $1.23. So we're saying that as of this moment, every 5 days, a 5-period ATR, on average, this ATR, this ETF is moving $1.23 on average every 5 days. And the bullish cross and this strategy gives us direction. So, and our strategy tells us how much time we need in the option, and it's usually between 1 and 2 months in the option time to reach our profit objective. And that's in the trading plan in the stats. So, and for XLB, it's 90% of the time when we get this trade signal, the ETF will move 1 ATR upward within the next 1 to 2 months. So that's going to be our minimum profit target based on the open price the next day. So here's the day we got our trade signal. Okay, this is 622.23. Excuse me. Yeah, 622. Now, the next day, the ETF opened at 79.48. So our price objective, our profit target is going to be based from the open price the next day. So what is 79.48 open and plus 123? So please type it in. What is 79.48 plus $1.23? 79.48 plus $1.23 is what? 79.48 plus 123. $1.23 is what? Please type it in. Again, 79.48 plus $1.23. Let's scroll down. Okay, 80.61. I got two numbers, 80.61 and 80.71. Which one is it? 80.71. Okay, cool. All right, so the next day when the market opens, at the open price of the ETF or lower, we're going to buy the first in the money option. It's going to be either 1 or 2 months out of time. And the trading plan will tell us what the stats are for 1 month out and for 2 months out, called expiration cycles. So based upon the trading plan, we will determine which option to buy. That's detailed in the plan. So, and it's going to be the first in the money option. So that next day it opened at 79.48. So we'd be based on the open price. Let's say we're getting in right near the open. We're going to be buying the 79 call option. That's the first in the money call, the 79. And our target's going to be $80.71. That first day, the high was 79.82, so the target was not hit. The second day, the high was $80.60, so the target was not hit. This day, the target was hit, the high was 81.70. So our profit target was hit within 3 days. This is a type of trade when it moves this quickly, you're looking at a 20-something% return at the first target or sometimes higher. At the first target, okay? If you want more, then you have to take part of your position off, book those profits, and then trail stops in the remaining contracts and hope you catch a trend. That happens at least 2 or 3 times a year that you can catch that bigger trend. It doesn't happen every single trade. That's not realistic. Those big moves where everything just takes off and goes happens just a couple times a year. And so you try to be consistent with your trading, and eventually you're going to catch it in multiple ETFs all at the same time. Multiple ETFs. Okay, so we'd be buying the in the money call option. If this is 623, we're looking at September options or August options. So this would either be September or August options for this, given the particular date. It'll be September or August options. 79 call, and your profit. So what we do, we buy the call option, the in the money option on this day, and just put in a contingent order to sell whatever number of contracts when the ETF reaches $80.71, and you walk away. You just walk away. There's nothing else for you to do. If all you want is the first target, and you don't really care about trailing stops and getting more profits, you don't have the time or desire to keep track of positions and manage different contracts in one position. If you have no desire to do that or time to do that, then you just put in, then it's all in, and then sell all your contracts at a first target. That is what gives you that about 20%, about 15 to 20% annual return with minimal work. Okay. Now, this is straightforward. It's a 20-something% first target. Sometimes it takes longer. It might be a lower percentage, but let me give you break out the calculator again. when I say average 25%, I want to make sure you understand average, because people tend to think I'm going to get 25% on every trade. No, that's not what average means. I want to make sure everyone understands it, because a lot of people think that I'm not getting 25% return on my trades. You're not going to get 25% return on your trade. So I'm going to put in some numbers. I'm going to have you tell me what the average is. On one trade, you get a 5%, 5% return. On a second trade, you get a 40% return. On a third trade, you get a 3% return. On a fourth trade, you get a 55% return. And on a fifth trade, you get a 33% return. Those are 5 numbers. What's the average return on those 5 trades? Remember, you add them all up, divide by 5. What's the average percent return? Okay. Is that 27? All right. That's how we trade. That's how we make money. With options, we don't know what our return is going to be at the first target. You might have a gap where you thought you might be getting a 10, 15% return. You end up with a 60% return because of a market gap and volatility working in your favor. Sometimes you might be just a slow grinding trade where time decay, where the movement is barely compensating for time decay, and you end up with a 3% return. Okay. Sometimes it moves fast, sometimes it moves slowly, sometimes it gaps. With options, we don't know, but we know that we're going to be net profitable. But this is an example of averaging 20-something% return. And I know I've worked with a lot of people as a coach, and people get frustrated because what they'll see a 5% return, a 3% return, a 15% return, a 10% return, and all in a row. And then they'll see another 7% return and a 20% return. And they get discouraged because then they get a loss and they're not making any money. Well, guess what? The percent returns don't happen in the order that you want them to happen. This is big picture. You have to have a big picture view of trading, not just what's happening this week or this month. This is how numbers work out over time. This might be a month where all your trades are averaging 5 to 20% return this month. Next month, you might have 7, 8 trades all averaging 40, 50% return because they happen in bunches. So you really have to understand that big picture view of the numbers and what to expect realistically. So yeah, you might get a stretch where you get a smaller percentage return, and know that is normal. Eventually you're going to get the bigger returns, and the bigger returns, as long as you're consistent with your trading, because you never know when it's going to happen. The reality is most of the time markets are trading in a range, up, down, then it'll break out for a while trend. Those are the big wins. And then it'll go back to trading range, then break out again and go. And those several times a year when things just break out and go, that's when we make the bigger dollars, because we get those bigger trends. But most of the time, we're just booking profits, consistently booking profits, and it adds up. And then all of a sudden, boom, it takes off. And that's what we're kind of setting up for right now. This year, for those people who understand seasonality, this year, seasonality has been dead on. The market's been doing exactly what we expect seasonally. The summertime, especially in August, markets pull back. So when the markets pull back this August, that was picture perfect, expected. So when you see the market going down and we have a whole bunch of sell signals, that is beautiful. That is exactly what we expect. And right now we're all setting up for a bullish run, and we're not there yet, but we're setting up for that. And the timing is perfect because we expect that in the next several weeks going into October. We expect it. Okay. So when that's seasonality. So when the markets are actually doing what we expect, perfect. You can trade with a lot more confidence when you see those first buy signals happen in a couple of weeks. Get your trades on, because the markets are doing exactly what we expect them to do. Seasonality. We're not trading totally on seasonality, but if you understand it, then you have a lot more confidence pushing the button, taking the risk, and placing the trades, because you know the markets are doing exactly what statistically they're expected to do at a certain time of year. So even with our strategies giving us 84 to 90-something% winning trades overall, knowing that seasonality is also tied into it, and you see the buy signals happen with an 88% probability of success with our strategy, it also happens at the same time when we expect the markets to go higher. Cha-ching, place your trades. This is why I say there's a time of year when we expect the most profitability from our strategies because of seasonality. There's certain seasonal patterns at the end of the year and the beginning, first part of the year, that creates bigger trends. It could be trends up or trends down, but we get trends, okay? And those are our times when we get our biggest profits. So those are the times we want to be trading. If the market goes up, that's even better, but that's really the expectation. But if it goes down, be ready for it too, and just stick with the strategies and the probabilities. All right, so let me show you an example. You see this happen multiple times when orange line crosses blue line, cha-ching. And it's an ongoing thing. Orange line crosses blue line, cha-ching. Just constantly booking profits with the strategy. Orange line crosses blue line, cha-ching. Okay. Now take a look at where we are right now. I'm waiting for this orange line to cross the blue line, and then cha-ching. Seasonally, we are right at that time where we expect the markets to go higher, going into that October time frame. So I'm looking for our first set of buy signals. This is XLB. This is the material sector. We take a look at the SPY, S&P 500. Same situation, already starting to turn up. He's getting there. Might be another week or two, and we see the cross. Take a look at Q's, NASDAQ. Even closer. It's all setting up. We've been in a massive uptrend that hasn't changed in quite a while. I usually show that weekly chart. The weekly chart is massive bullish, wicked bullish, okay? And all we do, we just have the occasional pullbacks. So the markets in here. Let's take a look at financials. Same situation. We're just waiting for it to turn up. Home builders. They're all in the same situations, waiting for it to turn up and get that first buy signal. That's why I'm saying this timing for this particular meetup is good. For those of you trading the strategies or want to learn to trade the strategies, now's a good time to actually get in touch with me to learn the strategy so we can be ready to make money going into the end of the year, because now is perfect timing in the next couple of weeks to learn. It's a group of 6 strategies, not just one strategy. I usually show this one. The other 5 I show to coaching clients, but this is 1 out of 5 strategies. This is going to be the first one that becomes, well, it's actually the second one that becomes a buy signal. The Ichimoku one is the first one that becomes a buy signal that shows market bottoms. This is the second one that becomes a buy signal. So Ichimoku's first, and this one second. You know, a few other sectors in here. Let's take a biotech, the IBB, that's also in the handout. Even closer. Okay. So everything is getting so close to that buy signal at the perfect time of year for seasonality. That's why I always say this is the best time of year to be ready to trade and be ready to trade. This is when we make our money. And knowing our probabilities is huge. I'm going to go back to the handout. Let's see. Okay, going back to the handout. We always know our numbers. So we know that these trade dates, we have the entire history of trades of this strategy on this ETF going back 20 years to 2002. Okay. This is one of our favorite strategies, one of Becky's favorite, most profitable strategies. She really likes this one. Okay. And it's really important to know time. If you just know price, oh yeah, it's going to move this many points, great. How much time will it take to do that? That's how people lose all their money trading. They don't, especially with options, they don't know which option to buy. They could be totally right. And quite often people are right, but because they're buying options which expire, by the time they are right, the options have expired worthless. So you really, really, really have to understand the probabilities and how long it takes to achieve your profit objective. You can't just say, I'm going to have a 3-point target and just make a number up out of the air and then buy an option that expires in 4 weeks. How did you just made that up in your head, unilaterally declared it to be true, and then risk your own money on it. Literally stuff just made up in your own head and declared it to be true, which is what many of us do, especially early on in trading. And that doesn't work. You'll get lucky a few times, then you lose all your money, and eventually you just move on to some other things. So we don't do that. We don't guess. We don't do that type of thing. Everything we do is statistically verified, and not just statistically verified, but we have to trade it live. It has to be traded. Not everything that you back test works out with live trading because of multiple variables. So I can back test something and have 99% wins, but one loss can wipe out all your profits because of the trade management doesn't work based upon what I'm doing. So big picture, it all has to come together. There was someone at Thinkorswim, it was back in the day, it was Don Kaufman. It was Don. He used to talk about that. We'd have people, but option trades where we'd have 90-something% wins, and on 1 or 2 trades, we just wipe out all profits. And he's seen that so many times. I've seen it. I've been there, done that. Hey, I'm guilty of that too. I literally remember one time I had 25 straight winning trades. And then on one trade, I gave back every single dollar of those profits from those 25 winning trades, all on one trade, because I had my risk management totally off and I did everything wrong on the risk management side. So that doesn't happen anymore. I've grown past that. And so now I know if I risk a certain set amount per trade, I know how many trades I have to place to know I'm going to be profitable. And I have a realistic expectation annually of my profitability if I risk a certain amount of my capital per trade. So let's take a look at this. This is one expiration cycle, basically 1 month of time. It's 79% wins. So 79% of the trades will reach the first target within 1 month, as opposed to if you have 2 months worth of time, 90% of your trades reach the first target. Think about the amount of profitability difference. With 79% wins, you're lucky. Remember when we did a 25% return on a winning trade and you needed 4 wins and after 4 wins and 1 loss, that's 80% wins and you are still just breaking even. Okay, think about that. There's a fine line between making money and losing money in trading. Very fine line. If you don't understand how the numbers work, especially with options, this is different with futures. With futures, it's different. With futures, every win we do is about a 40 to 50% return. We know that. So we don't need as many wins to offset a loss with our future strategies. But with options, we don't know how much we're going to make on a winning trade because option variables, the pricing can be anything. Okay. That's why we maintain a very high win to loss percentage, because we know we're going to make money as long as we're consistent with our trading. So knowing how much time we need is key. We know that if we only have 1 month worth of time, this is going to be a losing proposition. Okay, this isn't going to work out for us. We're going to do all this trading and we're going to come out maybe break even, but we don't make any money. Okay. Now, if we're doing 2 expiration cycles of time in the option, the exact same trade, there's a little bit higher upfront cost because you're paying more for the option, but we have so many fewer losses. And then you can turn some of these wins into bigger wins with trailing stops. And then the money suddenly adds up. But now so you'll see when I publish the list of trades valid over the last few months, it's always based on 2 expiration cycles or 2 months worth of time. So we know more time will give us better results. There's a higher upfront cost because you got to pay more for the option, but well worth it versus taking losses and then having to take 3, 4, 5 wins to make it up, because you got to make back those losses. And the more losses you create, it just becomes frustrating. Even though you know in the long run you're going to make your money back, it's just frustrating having to dig yourself out of a hole that you didn't need to have been in the first place if you had just gotten 2 expiration cycles. Because sometimes literally the moment that your option expires worthless, the next week it would have been profitable. And anyone who's been trading options for a while has been there, done that. All right. Yeah, if you only had 1 more week, it would have been a great trade, but it happens. Okay. So I'm gonna go down to that other example, XL. This one I was showing with IBB. This one is XLB. IBB is biotech. This one is 90% wins at 1 month and 93% wins at 2 months. This is why I like XLB, because with the win-loss percentage so high with 1 expiration cycle, which is 1 month of time, I am comfortable buying the less expensive option 1 month out. I'm very comfortable buying the less expensive option 1 month out, because of this extremely high win to loss percentage, even relative to 2 months out. Having these numbers available to you, and this is what we put out in our trading plan so that you can make an educated decision what you want to do, is key. So let's say you are buying an option 2 months out that costs more, because more upfront costs. You might get a 15% return on your money at the first target. But if you're getting the exact same trade because you're paying less, that might be a 25% return on your money at the first target, just because your upfront cost was less. It can make that big a difference just because you're paying more for that 2 expiration cycles worth of time. So suddenly, and if you get a gap, that 25% can be 40, 50% return at the first target. Or you get one of those big runs, then it just starts adding up big time, and you get a 60, 70% return with some trailing stops on a couple of contracts. Okay. I'm going to switch back to the charts real quickly, and I'll show you an example of how we actually make bigger dollars. It's more realistic with how I trade. And most of my trades would be like this. I'll pull up that IBB again. Give me the XLB. This is my favorite. It's always been my favorite. That and NASDAQ Qs. Okay, here's a trade. Like I said, you get into the open, $1.23. It hits pretty quickly. It's gonna be about 20-something% return that fast. I'm gonna go back to a valid trade. I'm gonna find a good example. Here's a good example. All right, this is XLB, trade valid on 2/24/21. Okay, ATR $1.24. The entry is, okay, someone write this number down. The entry price is 76.11. Someone type it in, 76.11. 76.11. Let's go ahead and type it in the chat window. 76.11. Someone type it in, 76.11. Okay. Now, our ATR on the signal day, we got our trade signal with $1.24. So what is 76.11 plus $1.24? 76.11 plus 1.24. Okay, Olga, 77.35. Okay. So let's say we got this, we got in the next day right at the open, and we have a $1.24 target. It goes against you for a couple of days, for a week or two, and then it hits your way, and the target is 77.35. On this day, the high is 77.46. On this day, the target's hit with a $1.20-something target. On this day, the target's hit. That's going to be a nice return. Probably not 15 or 20-something% return. Okay, now let's say you had other things to do this day. You didn't place the trade. Okay, you had other things to do. You get in this day, the next day. Now, if you get in, let's say you're getting in at the open on this day, as long as you're below the entry price, which is the open the next day after the trade is valid, and the first target has not yet been reached, the trade's in play. As long as you're below the open and the first target is not reached, that trade is still valid and tradable. But let's say you didn't get in this day because you had other stuff going on. The next day, you're going to check, hey, what trades did I miss that I can still get into? What trades have I missed which I can still get into? And you see, hey, there was a trade valid on 224. It hasn't reached a target yet, and I'm down lower. Oh, perfect. Let's say you're going to get in at the open price the next day, just because it's the open price, you're there at the open. It opened that day at 74.31. You're going to get the 74 strike option. And you're going to get it 1 or 2 months out. So it's going to be either April or May option. It's going to be either an April or May option. Okay. And you get, so, but now, here is where the bigger profits come into play, or potential profits, depending on your choice of targets, because you have flexibility now. We know our target is 77.35, but now we're getting in at 74.31. This open. What is 77.35 minus 74.31? So 77.35 minus 74.31 is what? Again, 77.35 minus 74.31. Okay, $3.04. Right. If you got in the next day because you missed this day, the trade's still on. The trade's still valid, but now you're getting in down here. Now, instead of having $1.24 first target, you now have a $3.04 first target. Now, instead of looking for a 20% return, you're looking at a 50 to 60% return, because remember, as the option starts moving your way, you're getting deeper and deeper in the money. You're starting out with about a 55 delta, and you're going to be hitting 70-something delta real soon. So as it moves further and further in the money, that the percentage return starts to magnify. Okay, so to get exponential. So now, where we would have been expecting a 15, if you got in up here, you might have gotten anywhere from a 15 to 20 something percent return at the first target. But now you're getting in down here with a target that is more than twice as big as you were expecting. Over here, you had a $1.24 target. Now you have a $3.04 target, more than twice the size you were planning on. This suddenly becomes a 10 to 15, a 15 to 20% return, all of a sudden becomes a 50 to 60 something percent return to first target. And this is more how I trade. I do not rush in at the open the next day. I've not been there at the open probably since 2020. Hasn't happened. I don't get up at all. I'm not out of bed at 6:30. It doesn't happen. I don't play trades at 6:30. I look for these opportunities, trades I'm not in, trades that have pullbacks, trades that have triggered. It was valid, but it hasn't hit the target yet, pull back, and I'm going to get in down here. The probability is still the same. It's still the same 90% probability that my target is going to get hit. That hasn't changed, except that now I'm getting it at such a much better price that I'm magnifying my profits. This is how I trade personally. Some people will get in at the open just to get it over with and then move on with their life. I am in no big rush. I know the more relaxed I am, I can place fewer trades and get bigger returns. So I can, at my leisure, whenever I feel like it. If I missed all of these, I missed this day, missed this day, missed this day, I could still get in this day, or I missed that day, I missed that day. I can get in, I can miss a whole week, come back on this day. I can get into this trade anytime this day from all the way down here at this price. I can get into this trade. It's still valid. And it's still going to be a huge difference in profitability because I'm getting it at a much better price than expected. Even this day, I'm still below the open. I'm still below my entry price. Here with even on this, I can still get in lower and have more of a profit. Okay. This is how we trade. This is how we make our money. This is how Becky loves to trade. She tells me, oh, she's gonna, when she sees the market pull back like this. So here's what I would get from Becky. She would be like, oh, I see the market's pulling back. It'd be a big drop somewhere, and then she'll tell me she's going to look for trades that she may not be already in, and then look to get into them. That's the perfect time to look to get into long trades that you're not already in, because you already know the probability. The only difference is you're getting in at a better price than expected, because we know 90% of the trades hit our first target within 1 month. If you get in down here, still 90%, but now our target is 2 to 3 times as big. So like I said, that becomes from 15 to 20 something percent return to instantly 50 to 60 something percent return, sometimes more if you start trailing stops. Because if you trail stops here, you sell part of the position, it just keeps gapping and going. Then now you're looking at the 70, 80, 90% return if you're trailing stops. But this is how I trade most of my trades. I get in, I look for a better opportunity than right at the open, because I know it's worth my while. I'd rather place one really, really, really good trade than 3, 4, 5 okay trades. But that comes with time. So, and the more you're comfortable and understand this, what some people will do, which I know for a fact, they might be on the meetup right now. What they'll do, they'll look at the open, and they won't jump in right away. They'll wait to see the market come down a little bit, and then they might be getting in somewhere down here. So now, instead of getting in right at the open at 76.11, they might be getting in at 75.40. So now they're getting in at 70 cents better. So instead of having a $1.24 target, they might be having a $1.94 target, because they're getting in 70 cents lower. That's what a lot of people who trade our strategies do. They still want to get in this day, but they'll wait to see the market pulls back a little bit, and then they'll get in. Or they'll miss the trade or wait a couple of days, see if it comes back down. But that's what they usually do. They'll try to wait for a better price during the day and still have a much bigger target. So now their 15 to 20 something percent return might come out to more like 30 something to 40% return, because they have a bigger target and they're going to be deeper in the money as the market starts moving their way. Okay. But I said it, and it all goes back to having a repeatable strategy, whatever it might be. If you want to work with me on our strategies, great. Now's the time. Now's the time. Call me, email me right after this so we can set something up, because we're at a time of year and it happens every year. Now is the time to gear up, get all 6 strategies working for you at this time. And this strategy, Ken, you have the plan. So you have the other strategies for the short positions. You have the T-line, sell, and the squeeze. So remember, we have the strategies for selling, shorting market tops. I'm going to switch over. For those people who only trade long, you might have a tough year this year. Oh, bad one. Yep.
My question was pertaining to the technique of the trading technique, not the trading strategy itself.
Okay, got it.
Being able.
Oh yeah, okay. The same. It's the same as far as strategy goes. Different strategy, same technique. We don't have
in other words,
on here.
In other words, what I'm asking is entering a trade after the valid signal has point.
Yes.
Okay.
Yes.
But in a short environment though, not a long.
Let's say we had our sell signal right here. Okay. I don't have the squeeze on here now, but let's say our sell signal happened right here.
Oh, you have to use a different trading strategy.
Yeah, a different deal. But let's say we had our sell signal right here on this day.
Yeah, I'm with you.
Our normal entry would be right here to open the next day. However, that ATR will be $1.29. And it'd be $1.29 subtracted from the open price here. And it's gonna be a good trade. Okay. But it's gonna be a much better trade if we got in a couple of points higher, right? Because instead of having a $1.29 target, if we got in a point higher, we'd have a $2.29 first target. So you'd be deeper in the money. And so our profits go from 20 something, 30% to quickly 40 to 50 something percent return on the exact same trade, but we're getting in higher. And I haven't shown this that much to people, but depending on how you choose to trade, let's say you risk $1,000 a trade. Let's just stick with that number. You might get you might get 3/4 of your position, or let's say $2,000 a trade, or 1,500. You might want to put on 2/3 of your position or 3/4 of your position at the open, or somewhere in here. And if the market goes higher, put on the other 20 to 25% or 25% of your position. See what I mean?
Yeah, I see what you're saying. And
so this is stuff I learned from John Carter way back when with futures, where because of the volatility was so high, it's not uncommon that to get big retraces. So you put in, let's say, 2/3 or 3/4 of your position right when all at the same time. If it drops, great, you make money. But if it goes against you first, then you're keeping your overall risk the same, but now you're going to put on that last part of your position higher. So now I'll use the word dollar cost average. Your average cost is actually lower and your profitability becomes higher because you are getting deeper in the money with this option will make you so much more. Plus these going, so this option you're getting in higher will be deeper in the money as it goes lower along with this one. So different ways to get into the trade, but hold something back so that if it still goes against you, you can put a little bit more on at a different price. That's another way of doing it. But usually you got to be trading a little bit bigger size position to have enough capital to do that left over.
Yeah.
If you're just doing 1 or 2 contracts, it won't work. But if you're putting on like $1,500, $2,000 per contract, per trade, then you should have enough capital to be able to do something like that. But it's a little more advanced, but it just adds the profits. It's just more profitability.
I think the tricky part in that scenario would be to know or to have an idea at what point are you going to scale back into those other positions.
And it's
Um,
subjective.
yeah,
What
it's
will see the
yeah, it is
question?
very subjective.
Yeah, yeah, it is.
Okay.
It's like, you know, you're holding back some money, so whenever you want to push that button, you know, that's it. As long as it's better price than expected, the probabilities are still the same. So it's going to work out for you anyway, one way or the other. But it's just that if it keeps going higher, you're going to be, I should have waited a little bit longer, but it's still going to be good. Where will you keep your stop loss? Your risk is your stop loss. Your initial stop loss is your risk. If you buy $1,000 worth of contracts, that is your risk. There is no physical stop loss. On the option trades, you do not manufacture stops out of arbitrarily. On the option trades, whatever you buy for the option, that is your stop loss, the cost of the option. That is the benefit of trading options. If you're trading stock, shares, Forex, futures, you want to have a physical stop. But options is totally different. That's what gives us the advantage over the futures traders, gives us the advantage over the Forex traders, gives us the advantage over the stock traders, is that we do not have to have a stop loss buying calls and puts. The cost of the call or put option, that is your risk, that is your stop loss. Okay. Now, after the first target is reached, then after you take part of the position off, put profits in your pocket, the remaining contracts will have a physical stop loss because you don't want to give money back on those. But initially, there is no physical stop loss other than what you paid for the option. That's what gives us the advantage. And we don't care if it swings against us. Well, who cares? Because they go against you, they come back. They go against you, they come back. Volatility works in your favor, especially going down. Going up, there's always some trades where, remember that 3%, 5% thing? Example at the beginning, that is the example of, hey, you don't know because time decay will work against you. It goes slow, it goes. So some trades will be big winners, some trades will be smaller. But you never have a big loss because you control the risk with the amount you paid for the option. If you control the risk, you control the risk with how much you pay for the option. You keep every trade approximately the same, then you can have a predictable amount of income every year. Like I tell people, if all you do is the first target and you get and you're consistent with your trading, you're looking at a 15, 20 something % return on your account per year, risking 2% of account per trade, getting in 10, 15 trades a month. If you are totally undercapitalized, those numbers are going to fluctuate because you have to have enough money to place trades. The more capital you have, the easier it is to be profitable. Like anything else in life, the more money you have, the easier life gets. Okay, that's reality. If you want a 30 something %, 40% return, then you have to go to that risking 3% of the account and maybe 4% of the account risk per trade, exact same strategies, and it adds up. You double the risk, same exact strategy, same exact % probabilities, you double the returns. You don't want to be risking more than about 4%. That's just really high. 2% is ideal. 3% is okay. 4%, I guess it's okay depending on what you're trading, how much you're trading. It just depends. But that's usually I go over with that with people to see what they're doing to make sure the numbers actually work out. But like I said, that is an individual thing. And you're going to find the reason we like this strategy is because it just works so well. And you see all these things. This is the Russell, once again, setting up for that cross up. But once it crosses, we go. Like back in a few months ago, when we had all these things cross up at the same time, they literally all crossed up at the same time. We see this gap. When you get a gap like this, you get in, here's your trade valid. Get in sometime in the next week. You could get in this day, this day, this day, this day, or this day. You had 1, 2, 3, 4, 5 days to get into the trade because in all 5 days, we at some point in time, we were below the open. The open price the day after the trade was valid is 175.25, and we were below that price on each one of these 5 days. gap, cha-ching. Once we gap, we know our stop loss isn't go. We know we have profit locked in. We're going to hit our targets probably on this day or this day, and just kept going up and just keep trailing. So if you had, let's say, 2 contracts, you sell 1 contract automatically at the first target, and then you move. Let's say you paid $6 for 1 contract, $600. At the first target, it might be worth $800, 20%, 30% return because of the gap. Because of the gap, got about a 30% return. So that $600 contract is now worth $800. Okay, you take times 2. Okay, so you take 1 contract off, move up your stop to lock in a certain percent of that $200 profit on that other contract. On the 1 contract, you had $200 worth of profit. Put that money in your pocket. On the other contract, you had $200 worth of profit, but you're keeping that one on. But you move, if you paid $6, you might move your profit up, your stop loss up on the contract to $7, let's say, on the contract itself. So let's say if the contract value dropped down below 7, you get out. It's your stop, but you still have $1 worth of profit. But it kept going up. It kept gapping up. It kept going higher. So as it kept going higher, you keep, each day it goes higher with more profit, you move your stop loss up. So your stop loss might go from $7 to $7.50 to $8 to $8.50. And you keep moving the stop loss up to lock in more and more profit on that second contract. That's how we trail the stops. All of a sudden, your 30-40% return at the first target becomes 60-70% return by the time the whole position is over. Okay. And the stop loss hit on remaining contract. It adds up really fast, but only happens a couple of times a year. You don't know when, you don't know what different sectors. You heard about sector rotation. This is how we capitalize on sector rotation. We don't know which sector is going to be in when, but we know we wait for our buy signal. Our buy signal is very reliable and consistent. I'm going to show you real quickly some of the other percentages on the other grouping of strategies. So you have a kind of idea. Some of you have seen this before. Let's see if I have it up. Let's see. Thought I had it. Screen. Okay. Here it is. Okay, so once again, these are the sectors we trade. This is not the strategy we looked at today, but it's one of the other 5 strategies. This is for one of the long strategies, the T-line buy and sell. This is on the long side. You can see the difference between 1 month worth of time and 2 months worth of time. If it's in light blue, it means that it's 84% wins or higher. We only deal with 84% wins or higher, and Becky updates this quarterly and sends it out to everyone we coaching. So we go by the stats, we go by the numbers. But just take a look at how big a difference is. You trade natural gas going 1 month of time versus 2 months of time. And this is what people, you can't just be guessing how much time in an option. You cannot guess, especially with options. If you were doing shares, you might be okay. But you can't guess with options because options will literally cease to exist. They will expire and you will lose all your money. You can't hold an option indefinitely. That's why you need to understand how much time is really needed in the option before you just go purchase an option, or else you're just going to burn your money away. You know, been there, done that. You're just going to melt money to cease to exist. And that's annoying because all of a sudden your trade expired worthless, and then 1 week later it would have been a profitable. So that's why this is key to understand these numbers. So this is one of the strategies on the long side. The same strategy on the short side. So we know certain ETFs are not high enough for us. We don't trade it. So it has to be 84% or higher. So if we see metals or oil XOPs, oil production companies, XRT retail, if we see these numbers or one of these ETFs, then we'll consider taking them, that trade. But if we see like silver short become valid on a chart, we're going to pass because the win percentage is way too low. Now, I do know people, and some of you know those same people, they have advanced degrees in mathematics, and they've looked at some of these stats, and they're okay taking these low percentage ones with certain bigger targets, because with their advanced degrees in statistics, little advanced degrees in statistics, they come up with values where they say, well, as long as we do this, this, and this with our trade sizing and everything else, we'll be okay. And they were okay with it. I'm like, great, but I don't have advanced degrees in statistics. I just know straightforward the charts, and this is how we trade. Like, can you make money? Yes, but you have to do a whole different mathematical analysis of how to expect to be profitable. Another one of our buy strategies is one of the hooks we do. Once again, the difference between one cycle of time, meaning 1 month and 2 months, big difference, especially in the percentages. And so this is why more time is better, higher upfront costs, but more time is better. But you got to have this in front of you to make an educated decision. This is how we know our option trades have a high probability of success. This is our strategy for buying market bottoms. This is what we use for market bottoms. This will be our first valid trade signal coming up in the near future. We're just waiting for it. And then the Donchians will be our second. We're just waiting for it. And this is how we short. This is how we do market tops. We short market tops with this strategy. It literally gets us into the tops of markets before volatility makes the put options really, really expensive. So this literally gets us in at the tops of markets, so we can trade down and profit and benefit from the option price increasing as it goes down. This was our big strategy over the last month or two, because the market was basically short. I'm going to switch over to the trade history, which is also on our website. This spreadsheet is on our website, so you can download it and take a look at it for yourself. This are the trades in 2023, all long and short. Okay. And over the last couple of months, the shorts have been in control. Okay. And so the shorts have been in control for most of the sectors. So these all get us in at market tops. So every rally will end with this trade signal. That's why it's so important to trade short, because otherwise, from July until now, if you were looking for trades, there are going to be some long trades that are still in play that are just going against you, but you're not booking any profits. So we always want to be booking profits. So when the markets are going down, we want to be booking profits. When the markets are going up, we want to be booking profits. That's why we trade long and short. So no matter whether it's a put or a call, we go by our trade signals. It's still 84% wins or higher. And I really liked this ETF squeeze is our favorite. If we did nothing but ETF squeeze sell, I'd be happy. Nothing but that. And because it's, even if it goes against you for a while, all of a sudden it starts. We've had these trades. This happened in 2020. Going into the beginning of 2020, we had a lot of these ETF squeeze sells before the market sold off in like end of January and February, before the market sold off. We had a lot of these sell signals, but it would a sell signal keep going higher, a sell signal keep going higher. Guess what? People in the know are already placing trades ahead of the market drop. It's not some big surprise, the whole world. People in the know are already positioning for a market decline. That's reality. May not be you and me, but we need to be able to recognize when people who control a lot more capital than you or I do are getting short. And this is one of our strategies to recognize, hey, we're seeing some sell signals here. Let's get our trades on, because we never know when the big move down will be. And we had some of these trades where we might have bought an option for, let's say, $5, had gotten to a point where they're worth like 50 cents because they kept going against you, and you're thinking, well, this can't be good. All of a sudden, that $5 gap, and we're now $5 was worth $8, literally in a day or two. Went from $5, dropped all the way to 50 cents, and then gap, $5, 50 cents became $2, became $4, became $5, became $6, $7, $8, just with gaps, just like that. Just when you thought it was going to expire worthless, it just gap. It just get massive gap downs. That was back in the beginning of 2020 when things were shutting down with COVID. And that's why you get your trades on, position yourself, even if you staggering trades, meaning or scaling into trades where you get maybe put 75% of your position on and hold back 25% or whatever, but they're all stacked up, and you just capitalize on that move down. I have a question here. Do you know anyone? I can't. This person is someone who I know. This is for Alex, but this was something he did for presentations for some of the option groups in the South Bay. His first name is Dan. I'm not sure how much of that he's doing now, but he did it for us. And what I would do is, since I knew his background, he's done some presentations for, I won't say his last name. But what I would do before I did a presentation for the option groups in the South Bay, I would give him all of my strategies to back test independently of me, because I didn't want to go into those groups, since those are people I see regularly, and give them anything that doesn't work. Okay, so I would have Dan back test everything for me independently, give him all the rules, give him everything, and he would do an independent back test, and then actually send me a formal report with links to everything. It's just amazing, saying he confirmed everything I said was correct. And then I would give all my strategies to some of the best option spread traders in our group. One of them was PJ. One of them was I'm blanking on his name now. But a couple of them, and have them take these strategies that I have as pure directional trades, use the best spreads you know how to do, and tell me if you can find a better way to trade these strategies other than buying calls or puts. And they always came back to buy calls or puts because the spreads were not appropriate. It was inappropriate strategies to trade these type of strategies we have. For these type of strategies, buy calls and puts was the way to go, because they're meant for big directional move. Calls and puts, best way to trade them. But yeah, I was asked if I can. He's not a public person. He just helped out with certain things in the group, within the group, but he's not someone I can connect you to because he's not out there publicly. So, but his first name is Dan. Some of you might know who he is, but he has a master's degree in statistics and he's really good at this stuff. But he would take lower probability trades because he felt he could make more money because if he trades sites accordingly. But that takes a lot more math to figure that out. I didn't want to do that. This works for us. So, all right. Do we have any questions so far on anything? We did a lot of stuff with numbers today. This is the first time in a while I've done numbers like this. So any questions on anything whatsoever? Because there's stuff you really should have a general understanding of to be able to fully appreciate and be able to trust what you're doing. I'm going to switch back to this. I might lose you for a second. Okay, I'm going to lose you for a second while I get the share back. Okay. All right. So if anyone's interested in working with me on any of these strategies, please contact me ASAP so we can get going on it as soon as possible. Because like I said, you saw well those different charts were in setting up. We want to be ready for when those crosses happen. because there are other buy strategies that we want to also do, not just those. There, but we getting real close. So now's the good in between lull time to get ready for when those cross up, which hopefully in the next few weeks. But once it does, we just go and trust the strategies, trust the probabilities, trust the seasonality. I charge 1,750. Anyone wanted to work with me, let me know before the week is over. I'll take $100 off of that, 1,650. I do everything one-on-one. If you're in the Bay Area, you want to meet with me in person. I prefer in person, but Zoom's okay. All right. But I prefer in person, especially the first time, because you can do your charts on Thinkorswim. We can do your charts on NinjaTrader. Either one's fine for the options. So, but everything's one-on-one. You really need to commit at least 6 months on your end to understand how this works. At some point in time, you will have losses, and you have to see how you recover from those losses. Okay. So that is why I really need you to commit at least 3 months of trading the strategies consistently. Way back when I was an Optionetic student, they had a policy of, they actually had a refund policy that said, if you don't make money within 6 or 9 months, they'd give you a refund. And I used to wonder how they could do that, because yes, we all do all sorts of weird things when given on our own, right? It's like, we're not going to follow it. What I actually found out is what they would have you do is to, which I finally figured out how they did that, is to have them show them their trades, the trades you placed following what they told you to do for 6 months. And if you followed what they told you to do for 6 months and you weren't making money, then they would give you a refund. But no one ever did that. No one ever followed what they said to do. Because if you followed what they said to do after 6 months, you'd be making money. So I finally realized that. And so that's why I put in, you got to have at least 3 to 6 months of consistently trading the strategies to see it work. Because you might and I say this all the time, even at 80-something% wins, you will have 2 to 3 losing months every single year. We had at least, after 8 months of trading so far this year, we have 2 losing months and 6 winning months. 2 of those losing months will be negated by 2 of those winning months. The other 4 months of trading represents our annual profits through end of August 2023. That's if you were consistent with your trading. I've had someone who, after the first couple of losses, 2 months, they had 2 months of losses back to back, they changed everything without letting me know. And they missed 4 months of profits. They literally missed 4 months of profit because they changed everything. So they dug themselves a deeper hole. But that's why you really have to commit at least 3 to 6 months to consistently trade the strategies, review things with me on a monthly basis, make sure you're doing things right. You might think you're doing it right. You might be just getting lucky. That's why I like to look at what you're doing with you, go through your trades, make sure your profit and loss looks okay, make sure you're managing positions not making too many mistakes. And that is my preference. We usually takes between 5 and 10 hours realistically, depending on how much one-on-one time you require, and I will spend as much time with you as you need. Some people meet with me every week for a couple of months. Some people meet with me once every couple of weeks. Is whatever you need. If you're brand new, I'll work with you to get your account set up, get everything just right, get your platform set up, or your trading platform, analysis platform, get everything just right. If you're an advanced trader, I'll still help with you with the exact same things, because getting your platform set up is not that simple. It can be confusing, and that's why I want to make sure your platform looks like my platform, your analysis, every platform looks like my analysis platform, so that we're all seeing the exact same thing the same way. Do not assume that if you have 3 different trading platforms, 3 different analysis platforms, that everything you look at in each one of those 3 different ones will be the same. They will not. I guarantee they will not. Okay. You will look at one thing and you'll see the closing price was this. You're going to look at another thing and see the closing price was something else. And they're both correct. Okay. That's why it depends what your setting is on your charts. You will see the exact same information displayed differently. And I want all of our information for everyone in our group to be displayed the exact same way. And I do email out the trades every evening of what we found valid, so you can compare it to what you found valid. So you're not on your own. You can join our Facebook group, and within our Facebook group, you can ask questions, and I post stuff there. But I do email you every evening. Here's what we found potentially valid. What did you find valid? And then what trades are you considering taking the next day? Let me know what you found, and we can bounce it back and forth. Make sure what you plan to do is okay. If you need total hand holding, I can get on a Zoom call with you the first time you place a trade. Make sure you get everything right. Make sure your order entry is right. Make sure your trade management is correct as you place the exit orders. I do it all with you, one-on-one, no group stuff. I do not want to do anything group. Doesn't work for me. What I found is that I might say something and you don't get it. I might have to say it 3 or 4 different ways for you to understand it. Okay. That's why I like to work one-on-one, because I need you to understand certain things, and I might have to literally say 3 or 4 different ways. This is lecturing. I do not lecture one-on-one. I guide you. I make you work. You have to work. When you work with me, you have to work. I will ask you to figure something out, and I will guide you as you figure something out. It might get momentarily frustrating. That's okay. I will guide you through the frustration, but I will not do everything for you. I will help you understand it, because trading is something you do on your own. So you actually have to understand what you're doing, and I will help you understand it. So that's my approach. No lectures. So this is lecture because it's a one-way thing mostly. But when it comes to actually trading, it will be and coaching, it will be guiding you and then answering any questions you have as they come up. I don't care when you have a question, you email me, is the easiest way to reach me. Need to get on the phone with me, I will get on the phone with you, not a problem. Let's talk through something, because sometimes it's easier to just talk about it than to write about it in an email. So, and if you want to do the full program, the daily charts, weekly charts on market internal, some of you know about, here's the price. This will take longer to implement. This is one, if you let me know before the week is over, take $500 off of this price. If you want to do options and futures, there's going to be a similar price, but you're going to take, it's going to be a few pennies less than this. But once again, if you want to do futures and options, let me know. And it's a nice combo to do futures and options. Futures aren't as many. With options, is maybe 20 to 40 potential trades every month. With futures, there's probably 8 to 15 potential trades every month. If you do both, it's actually nice because they complement each other. So if you're not making money on one of them, you're making money on the other one. And it's all swing trading, no day trading. We do not day trade futures. Everything is swing trading. So this one this is all weekly charts and daily charts and market internals. This will take more months to implement, but you'll have the big picture of everything we do available to you. And this one gets right into the meat and potatoes, the day-to-day trades. And like I said, over the next couple of weeks is when we're really getting into this. So let me know real soon so I can work with you starting this week, hopefully. All right, do we have any questions? You guys can set up the Donchian channel on your own, and the 40 and the Bollinger Bands. If you need help with that, let me know. It's pretty straightforward. There are a few detail-y rules that you should know, but I usually save that for coaching clients. But you have the general idea, concept, up to you to detail it. But I can get you the specifics. If you message me, I give you the specifics for this strategy. That's not a problem. And then you can implement it, back test it on your own. Always do some back tests. And when you back test, always make sure you back test all the way to 2006 or 7, because I've had people send me strategies that they tested starting in 2010, and they go for several years and say, this is the greatest strategy ever. Look at it, it's great, it works great. It's a long strategy, and they sent me a long strategy back tested at a time when the market did nothing but go up. Okay, so I'm like, take a strategy and go back to 2007 or 2006 and test it. And then it fell apart, because if you don't test something through 2007, 2008, and 2009, when the market was in the most prolonged downtrend in the market history, then your back test is incomplete and inadequate. You got to back test through that period to know if what you're going to do will actually work, or is it going to, or within a few months, it would wipe out all your profits that you might have gained within a few months during that time. So always back test through 2007, 2008, and 2009. Then you'll know you have a good strategy if it works during that time, especially when the market dropped 50%. Market dropped 50% during that time. So make sure yes, whatever strategy you back test goes back to that. That's why we put all this stuff out, and we back test to 20 years, some of them through 2006, others through 1999. Every trade valid on everything. All right. And on the website, you will find, so make sure you've all been there. I'm going to just do a quick transition over there. Share on our website. The handouts are here. Okay, the spreadsheet with all those files are available to you right here, so you can take a look at that same spreadsheet. Just go for it there. You can use the contact page to message me if you want any information about coaching or anything else, or to talk about your particular situation. It's always good to talk about your particular situation to make sure we're on the same page. And we quickly ask questions. And these are the same coaching programs, options, full options program, and also here we have the futures. You have to let me know I have to send you a link for the discount. And if you take a look at the homepage, so I know some of you have seen it, but I was interviewed on a podcast recently, and it went into how I bring together my martial arts background with my engineering background, with everything else I do, and how that all fits into trading, and my mindset and my approach to trading. So it's about a 30-minute podcast, a good one to listen to, because it was unfiltered. I was told there'd be, the guy could ask me any question he wanted to, and he did, and I didn't even have to hesitate. Whatever he asked me, I just answered honestly and truthfully, unfiltered. So, and I don't really filter a whole lot, so that's okay. So it works out pretty well. All right, so if you will need to reach me, my information is on the handout. Go to the website, behindscenes.com. I'll put that link on here also for the coaching program. So I'm going to put the link on the chat window so everyone has it. That's for the coaching programs, and you can find the link at the top to contact me. Unless we have any questions, we're going to meet again in 2 weeks on the 24th. That's going to focus on futures. And once again, getting into that time when we want to be trading, especially with options this end of year. So contact me soon. We get you started on the strategies, and you know what's involved, and you have a good feel for it. Unless there's any questions, we'll see you in 2 weeks. All right, signing out now.